We're bringing together some of the brightest minds in finance and economics to answer questions about the state of the economy and the path forward. Everything from unemployment to the stock market to debt to longer-term economic inequality. In this episode, we're speaking with Gary Shilling. He's a financial and economic advisor who has a track record predicting recessions. What do you see as the path forward for the economy right now?
I think what we're looking at here is really an L. It's declining. It's not the V. It's not a recovery in the second half. It's a continuing on down into 2021, and thereafter probably a relatively slow recovery.
What are some of the factors that will affect that shape of the recovery, so the L shape that you're referring to?
I've got a list of about 10 of them, but I think we're going to see a lot more people doing what we're doing, working from home. They're getting used to it. Commuting is not all that much fun. I think we're going to see a change in consumer spending habits. People are going to be a lot more cautious in terms of their spending as they go ahead. I think we're going to see downward pressure on prices. And that works to the advances of Treasury bonds, which have been my favorite since 1981 when I said we're entering the bond rally of a lifetime. And by the way, since then, long-term Treasury bonds have outperformed the S&P by six times. And I think we have even lower rates because of the safe haven effect and possible deflation.
So it sounds like you see a lot of real structural changes resulting from this pandemic, not just short-term changes. These are big picture, long-term changes in how we spend our money or how businesses operate or how governments operate.
Absolutely. I think that's where we are. Let's say you look at this versus the subprime mortgage collapse. Now, that was the deepest since the Depression of the 1930s, but it only affected directly a relatively few people. Now, it spread throughout the economy, but it was only those people who were speculating in housing who really got nailed. This one affects everybody. I mean, we're all basically combined. I mean, you're not in your office. I'm not in my office. Very few people are. The opening up is slower. Obviously, the politicians want to open up quickly to get the economy back on track. That's true of governors. It's true of the president. But the populace is sitting there and say, "Hey, why should I risk COVID-19 and possible death?" So it is extremely disruptive.
I want to touch a little bit more. You mentioned deflation, and some people have said all of this money printing that we're seeing, all of this stimulus could in fact finally cause inflation, but sounds like you think the forces are in the opposite direction.
The only way I think you could get inflation is if we sealed off the borders. If you basically prevented imports, because we're in a global world, and as long as you have imports and excess capacity abroad, that's deflationary. But if you were to seal the borders and literally cut off any imports and then embark on this huge monetary and fiscal stimuli, yeah, they could create inflation. But I don't think we're going to go to that extreme.
Is there a chance of us moving toward an economy where all of the supply chains are based in the U.S., where we don't have any imports and where we really try to eliminate that global trade?
No, I don't think that's likely. But we are probably going to see it move to safer areas. Mexico, I think, will be a big beneficiary of this, and it will affect the U.S. But bear in mind, the supply chains exist globally because they're efficient. I mean, when you look at the situation, why would somebody put together computer chips in South Korea, then ship them to Taiwan for semi-assembly, and finally to China to put into iPhones and what have you? They do that not because they want to ship goods around the world, but because it's cheapest, it's the most efficient. So you're breaking that, but they want to reestablish them and take advantage of cheap labor. And Mexico, I think, is going to be a big beneficiary, but there's probably going to be pullbacks, particularly from China. And that's really been atrophying anyway with Trump's trade war with China.
Do you see certain sectors of the economy benefiting and winning over the next couple of years more than others? Are there areas where you are more bullish or less bullish?
I think the telecommunications capability is there. We just haven't used it adequately, and I think we'll utilize it much more intently in the future. We're probably going to see more online shopping, and that's not good for malls. But I do think it means that delivery services and so on are going to be strong.
Do you think that there will be more stimulus, and what would the ideal kind of stimulus look like from your point of view if there is more?
There probably is going to be additional. Small business is definitely in trouble. There probably will be more money there. If they provide more money simply for people to stay home, that's possible. I don't think that would be a very good idea because it encourages people not to work. They lose their skills. And you've actually had, in the entire post-war period, the participation rate, the percentage of males of working age that are either working or looking for work, that's been declining. And for women, it's been declining since about 2000. So you have these downward trends anyway, and these things accentuate it. So that may be more there, but I would not advocate it.
Should we be worried about the massive debt levels from the government side?
The facts are that deficits have not really mattered because you have so much liquidity in the world, so much supply. You remember after the Great Recession, there was a conviction that all the fiscal and monetary stimuli were going to result in huge inflation. As a matter of fact, a number of investors, including some very famous hedge funds, went to gold. Well, what happened? Big deficits, but inflation has come down.
Is there an argument just to forgive debt altogether? So, for example, like student loan debt or other types of household debt. Is there a reason to just kind of say, let's forget it?
Yeah, let's have a debt moratorium. If you're somebody with a big student loan, you probably think that's a great idea. I don't advocate it. I think people have to be responsible for their decisions. When people incur debt, if there is no responsibility for repaying them, they obviously are in trouble. But one of the things are, if we do have deflation, the problem gets even worse because in deflation, people's ability to generate income and so on in nominal dollars declines. But debts don't decline. They're fixed. And so they get harder to service. That's one of the reasons that the Fed is so afraid of deflation.
So are you still buying bonds now, or where do you stand on bonds?
Yeah, I'm still, I've been an advocate of bonds for 39 years, and I still think they're a great buy. And one of the interesting things are, if you look back at what has happened since the first of the year, the bond market started to rally literally the first trading day of the year. And that was an indicator that we've got big problems. Now, the virus was hardly known at that point. Stocks did not peak until February 19th. And, some of us believe that bond markets are smarter than stock markets, but I think that's the case. And so I think this is where we are right now. Now, of course, we've had this rally in stocks, but, I think we're in a situation very much like 1929 in the early 30s. You had a 600% rise in the Dow Jones Industrial Average in the 1920s, the Roaring 20s, and then between September and November of 29, stocks fell 48%. The Dow Jones. Well, everybody said, well, that's just knocking the fluff off from the 20s, and so it's all over and great days ahead. And so you had a rally of 48%. It actually retraced 52% of the decline. And that lasted into July of 1930. But then, as the depression unfolded, stocks really went into a skid, and they ultimately fell 89% from their peak. I think that's very relevant to where we are today. We saw the initial concern about the crisis. Stocks fell the S&P fell 34% after that peak in February 19th, and then people said, "Oh, it's coming under control. We'll be able to reopen the economy. It's really going to be V recovery." And I think that's what we've had at least until right now. But I think you've got a second leg down, and that's very much reminiscent of what happened in the 30s, where people appreciate the depth of this recession and the disruption and how long it's going to take to recover. And that's why I think stocks could decline from here another 30 or 40%, and that may be optimistic.
Wow, 30 or 40% from where the levels they are in May here.
Yeah.
And that's over the next maybe couple months or a year, or?
It could be a year. Stocks usually anticipate, and if the recession runs into, let's say it runs into the middle of next year, you wouldn't expect stocks to bottom until the end of this year, early next year. They usually anticipate 3 to 6 months.
what's the difference in stocks versus the economy? Are stocks ahead of the outlook here, and how are they so different from what's happening in
I think stocks are very much like that rebound in 1929, where there is absolute conviction that the virus will be under control and that massive monetary and fiscal stimuli will reinvigorate the economy. It'll be a V. We'll have strong rebound in the second half. And by a year from now, it'll just be a distant, faded memory. That's what I think is going on. But for my money, as investors begin to realize that this is a long, deep, drawn-out recession, then we'll start to see the effects. And that may take a couple of more months before you see that. I mean, right now, the second quarter is pretty much a write-off. But if it's clear that the third quarter isn't going to be any big improvement, that might be the time when stocks really resume the big slide.